Good afternoon. For those that don't know me, my name is James Yee. I'm a tax partner at SW. It's my pleasure to welcome you all to our Victorian Property and Tax Update seminar today. For those that were in attendance, we did a similar session, but in person back in May around the time that the state budget came out. So this is our second one in the series. We will hopefully look to do more, either online or preferably in person in the future. In our session today, we will be discussing the major changes in the Victorian property and tax landscape. I'm pleased to be joined by Chow Zhang, a director at Stonebridge Property Group, and also Robert Parker, a consulting director at SW, and also a duties expert with significant experience, both in the private sector and the SRO. Chow will enlighten us with the latest market trends and activity in Melbourne's commercial property world. I know that Stonebridge has been having a very busy year thus far, and the current momentum in commercial properties seems to be still building. I'm sure we're all interested to know what sort of prices are being achieved, what is the growth trajectory, and what types of properties are achieving the best results, particularly in light of the impact of COVID and the opening up phase that we're in right now. Following Chow, Rob will delve into the nitty-gritty of the newly introduced Windfall gains tax regime, which I'm sure we're all keeping a very close eye on. The bill was just released a week or so back, and we've been very busy at SW working hard to interpret the proposed law and to share it with you. We also have Barnaby McIlrath, a planning and environment lawyer from Align Law with us. He's an accredited specialist in planning and environmental law. Please feel free to direct any legal queries arising out of this seminar to Barnaby. Okay, before we start, I would like to run through some housekeeping. We recommend that you click on the Enter Full Screen button at the top right-hand corner to achieve the best webinar experience. If you click the Q&A button at the bottom of your screen, a window will pop up, and that will allow you to send us questions as we go. We will monitor these and answer any that we can during the presentations. Some we will save for the Q&A at the end of the session, but for more bespoke questions, we may need to connect with you after the session. Okay, with housekeeping done, I'd like to hand over to our first speaker, Chow. Chow, over to you.
Thank you, James. Thank you, SW, for hosting, and also with Align Law giving us the opportunity to do a presentation with you. So I'm just going to share my screen. Stonebridge Property Group, just a quick introduction about who we are, what we do. We're a commercial real estate agency. We sell sort of all facets of commercial real estate, including retail investments, office buildings, development sites, and small shops, freestanding retail at petrol station medical centres, and also industrial properties as well. So today, we just wanted to give everyone a bit of a market update about what we're seeing in the market. These are just a few news article snippets from what we've picked up. These are all very recent in the last sort of week and a half, in the AFR, in the Age. Anyone who's keeping an update on the property market, or anyone who actually just, opens up the paper, you'll see that there's a lot of talk about real estate. Across all facets, really. And I've taken a snippet out of all of them. This includes residential, office, rural areas like farmland, also what's happening with apartments, and, the tremendous growth with houses as well, and also a bit about industrial. So I'm not sure everyone can see my cursor, but the top left-hand corner, which talks about house prices moving before buyers' eyes, everyone knows how crazy or how hot house prices have gone so far. I'm talking to a lot of residential real estate friends. They're saying the market's as hot as ever, and it still is. The momentum's still there. Overall, Melbourne's house prices have increased anywhere between sort of 18 to 20%, and there's a few suburbs who have really outperformed that as well. So landed properties, so houses with land, and also townhouses have gone up very significantly, especially over the last 12 months. And that's across the board in Melbourne and Sydney. The bottom left one's interesting, where it talks about the office tower sales boom. So, tenanted secure income office buildings, whether it's in the CBD or the outskirts or Melbourne and Sydney, that's seen a real resurgence in demand and transactions as well. So we've noticed quite a few more transactions than last year. which just proves to show that there's still demand for well-tenanted office investments. This one next to that, rural prices surge as demand outstrips supply. That's a really interesting one. So a lot of the demand and a lot of the growth has been in rural properties. Obviously, the impacts of COVID-19 have had a big impact on that. People will be familiar with the Mornington Peninsula and how far, how high that's gone up with the pricing. We're actually selling a property in the Bellarine Peninsula. So that's on the other side of town around Geelong. There's a suburb there called Port Arlington, which we're selling. And when we're doing research on that, Port Arlington has gone up 53% in the last 12 months. So if you bought a house for average house price there, 550,000 12 months ago, it's now worth 850. So it's just crazy some of the growth that we've seen. There's an article there talking about some of the inner city units for Melbourne's apartments. I think, probably keynote for that one is there's the biggest disparity now than there ever has been between houses and also units. So the affordability factor is really, kicking in. And a lot of people who probably were looking at houses, they might have been priced out of the market and they need to look for higher density, either townhouses or apartments. So that's really interesting to see. And that's in line with the other two articles there from demand picking up, demand for apartments picking up by Mirvac. Now it's a sort of a big statement to make from one of Australia's largest developers, and also with the article below that as well. So going from unit to house has never cost more. The bottom right article talks about industrial. Industrial is an interesting sector that's gone from strength to strength over the last few years. We're seeing a lot of transactions happening for lower yields, on lower yields, similar to what we're seeing with retail actually. And the land price for industrial has really shot through the roof as well. The demand just seems to be so strong and the supply has been so limited as well. So we're seeing real price escalation for industrial assets too. I wanted to talk about what we're seeing on the ground, sort of firsthand experience from the day-to-day dealings. So a lot of the properties I'm about to talk about, these are all happened within the last week and a half, 2 weeks, except for some of these larger transactions. But these two are properties that we sold last week, both at auction. So Horton Street, Templestowe, under auction conditions, that sold for 4.505. That was actually put on the market at 3.9. So the vendors are very happy there, a lot of price escalation. I think what's interesting about this one, we sold a property which is very, very similar to this in Templestowe. It was at 79 King Street, Templestowe, a few months back earlier this year. And that was identical in size, corner block as well, very close to Serpils Primary School. So that went to auction, again, a very hot auction. That sold for 4.2. We thought this location is very similar, probably not as good, to be honest. We thought this would get around that price or maybe a bit lower, but the market's just moved so much in the last few months that, we ended up getting 4.5, so 300 grand above what that sold for. So that really gives us a live example of how the market is shifting and trending upwards for these type of opportunities. Kintore Street, Springvale, that one we sold at auction as well, sold to a Chinese developer. They're just going to buy it and land bank it. It's a pretty interesting site. You can build 10 levels on here, maybe sort of circa 150 apartments. It sounds like a lot, but just with where the market is for apartments in Springvale, the project probably needs another 3 to 5 years before it becomes feasible. So it is a pure land bank. The purchaser bought this with the intention to land bank and to develop it in about 3 years' time. They've got a lot of confidence with the apartment market later on with where Melbourne's heading, especially once the borders open up. The site's it's in the activity centre, very close to the train station. So I think it's a smart buy from them. One thing to note, across both these auctions, we had a total of 10 bidders, which shows us that it's not just 1 or 2 buyers paying these type of prices, and they're both sold at auction as well. So there's just a lot of depth in the market across the board for development opportunities. Moving on, we're talking about retail shops here. So these are just smaller investments. All these shops they sold in the last 2 weeks. I've put together a few photos just to give you an idea of what I'm talking about. You can see a list of the yields and some of the prices. You know, these shops range anywhere between 600 grand to $4 million, and the yields are generally speaking between 4 to 5%. One thing I do need to note is if you look at the addresses of all these shops, they're quite far out. So they're quite sort of regional, you know, small shop investments. For anything that's more inner city or metropolitan Melbourne, like, you know, if it was Hawthorne, Kew, Camberwell, Balwyn, or any of those areas, or Bay Street, Brighton, you know, they're trading at much lower yields, sort of between 3 to 4%, and sometimes even below 3, depending on the property. So that's a good trend to note. You know, interesting one was the Hillsville one. That's at 4.5% for a shop that's a bit further out, and given the price point as well at $4 million. This one is a little bit old, but I wanted to raise it with everyone just to show where these type of larger investments are. So this is a Woolworths Metro. It's actually the largest Woolworths Metro in Melbourne. The development was just completed, developed by Pace Development Group. They've got apartments above. So this was a STRATA retail, again, purchased by a Chinese investor. They put 19 million in here, just as a sort of safe investment for them. And on a yield for STRATA retail is 4.63%. So it's quite a sharp yield. And, you know, if this was 12 or 18 months ago, I don't think that it would have been as sharp. But again, Woolworths, very secure covenant, and they plan to hold for the long term. This is a freestanding Coles. So this is not Strata. Freestanding does have land. The location is a bit further out in Woodend. But even something like this with a price tag of 33 million, it attracted a yield close to 4%, 4.3. I remember our retail team, they sold a Woolworths in Torquay for well under 4% late last year as well. And that just seems to be the trend for these freestanding retail investments. You know, a lot of these ones, they're anchored or tenanted purely just by a Coles or a Woolworths or a Bunnings. So it's a very secure covenant. So for these really safe type of investment assets, we're seeing the type of yields that a lot of the buyers are transacting at. You know, we also sell some larger retail investments as well. This is Craigieburn Junction that transacted just last month. This has got a mix of shops, all household brands, big brands, secure covenants as well, but there's quite a few to manage there. This is purchased by a large super fund for 135 million, and the yield for something like this is around 5.45% in Craigieburn. So a summary of what we just spoke about, basically there's a lot of factors that are driving the market. The low cost of debt is one of them. So, you know, there's a lot of money out there in the market. We're seeing across the board for the development sites, for the shops, for these, you know, more secure assets, there's a lot of depth. We're selling all of these properties with a lot of underbidders that have missed out. You know, in addition to the ones we spoke about, we sold a site in Bentley for the Melbourne Football Club that had a price tag of 23.7 mil, and we had 24 offers on that one. We just sold one in Chapel Street, St Kilda for $23 million, and we had 14 offers on that one. So from a scale of smaller sites to bigger ones, there is a lot of depth across all of these opportunities, and we're seeing that across the board, especially for investments and development sites. And that covers the depth dot point as well. You know, we're noticing, generally speaking, a lot of positivity across all sectors that we're involved with, you know, with the retail investments, the medical centers, the childcares, development sites, and other commercial opportunities as well. The one thing which some people might question is the attractiveness of apartment opportunities or apartment projects right now. There are still quite a few developers who are very open towards looking at apartment opportunities. It seems like, you know, house and land subdivision sites, they're very attractive because there's essentially minimal sales risk. Same with well-positioned townhouse sites. But we're starting to see a lot of developers open up to looking at apartment projects and land banking them, because there's a lot of positivity around the saleability of the units later down the track, especially with where house prices are going. You know, a lot of people, you know, some developers have commented that it doesn't really make sense for somebody to buy a house in Hawthorne. It's almost $3 million, but you can buy a nice 2-bedroom apartment for $600,000 or $700,000. So there's just a big gap and disparity for apartments, especially in blue chip areas. So the next, I want to give everyone a quick rundown of the type of opportunities that we're selling now and the type of properties that we're dealing with. We feel like we've got a pretty good foothold across a lot of sectors in the market. So the one on the left is the Ballerine portfolio. That's the one I mentioned earlier. These farmland properties, they're beautiful assets facing the beach, but it's interesting how much inquiry we're getting for St. Leonard's and Port Arlington. There's just a lot of people who want a land bank. They see a lot of growth in the area. They know that Port Arlington's gone up 50% in 12 months, and they just want to get in. There's a lot of FOMO in the market for that type of product. 2 Fordham Avenue, Camberwell. The picture doesn't say a whole lot, but this is permit approved for 5 townhouses. The price point here is probably between 3 to 3.5 mil. It's a very attractive price point for a lot of developers. So the buyer pool is very big and we're getting a lot of inquiry. And I think generally speaking, a permit approved townhouse project in an affluent suburb, an affluent area has always been very popular and it still is. I don't think anyone thinks there's any sales risk with the actual townhouses. So we're going to go to auction with that one. Canterbury Road, Surrey Hills, again, a very good suburb. This one's got a permit approval for 5 levels for service departments, but it's also good for an investor or somebody who wants to do an alternate use on the site as well because it's its own commercial one. These are some of the investment opportunities that we're currently selling to give you a bit of flavour of the type of properties, the price points and what we're looking at. So Buckley Street, Aberfeldy. Aberfeldy is an interesting suburb. It's sort of like, a bit like Balwyn and Deepdene. Aberfeldy is the Deepdene. It's a smaller suburb. It's next to Essendon. It's got a median house price of almost $1.8 million. So it's quite a wealthy suburb as well. This particular asset is right opposite Essendon Keilor High School. So very busy area during school times. It's leased to a gym. They've been there for 15 years. So long-standing operator. They just signed up a brand new 10-year lease. I think the attractive thing about this is this will probably trade for around a 6% return. So it's going to be very attractive for a lot of investors who are looking for yield, and it's in a very wealthy location as well. And it's got large land and it's got a large building area as well. It's just under 1,000 square meters of land. Wattle Planet Childcare, that's a childcare center that we're selling, brand new childcare, brand new 15-year lease, super high occupancy. They're over 100% occupied and they're oversubscribed as well. They got a waiting list now. So it's a very good operator. This will be a very secure investment for any investor that wants to have a look at it, probably around a 5.5% return. If you have a look at the location, it's in a very good spot. It's right opposite a primary school too. Blackburn Road, Doncaster East, the one on the right, that's more of a trophy asset. Anyone who knows Doncaster East will know how good this location is. It's just down the road from the Doncaster East McDonald's. Super prime retail spot. There's a lot of popular restaurants and Japanese restaurants there as well. And something like this does not come up often. So there's a lot of interest in this property. There's development potential later down the track, but they're all sort of long-standing tenants and it does have leases. This will trade between, around the 4% mark for an investment like this. Anyone who wants information on any of these can just give me a call or contact anyone at Stonebridge. We've got a couple of upcoming opportunities as well. We're dabbling with industrial. That's going to be a big focus for our team. We've got one coming up on Mary Street in Blackburn. That one's very close to the Lexus of Blackburn dealership. So in that pocket of industrial, I think super tightly held. I only notice about 3 to 4 transactions in that pocket every year. So I think that'll go well. We're going to go to auction. And then we've got one coming up in Fairfield as well on Chingford Way. Both similar size, similar price points, but just let me know if you want more details on these ones. We're still preparing the marketing. That concludes everything for Stonebridge. But for any of the Chinese clients out there who's watching and listening, please follow our WeChat channel. Anything that comes up from us on or off market, we post on our WeChat channel, and we also post up general news as well. So if you can scan the WeChat code, more than happy to send around the slides after this as well. And that's it.
Thank you, Chow. Thanks a lot for those insights. I do have one question, Chow, as I was looking at your slides. What do you think is the trend going forward? Because I've been hearing some whispers, in terms of bank sort of potentially tightening the credit a little bit.
Yeah.
and that also with its impact on serviceability, for example. So what is your feel when it comes to the potential trend in commercial property, and understanding obviously there are different types of commercial property in play as well?
Yeah, well, the low interest rate environment has really driven a lot of the activity. The market is still supply constrained, and that's why we got so much depth on so many properties. So I think if the supply is still constrained, it's still going to continue to trend upwards. What the banks are doing, I'm not an economist, so I don't know what the end goal is, but it sounds like it's really targeted at house prices, as opposed to a lot of commercial. With a lot of the commercial properties that we sell, they're funds, or they're to high net worth, so they're not that impacted. And also, generally speaking, with commercial, with the borrowing, you need a fair bit more equity than just to buy a house. You need, generally it's about 40 to 50% equity. So I don't think the impact will be as significant for commercial investments.
Thanks a lot. Thanks a lot, Chai. And also notice you had some sites for sale, such as the one in Port Arlington, which I'm sure someone will be buying to land bank.
Yep.
And I guess these buyers will be very interested in the windfall gains tax that's being introduced. And
Yes,
I think that's a
highlight of the show.
with the potential sort of higher tax rate that is basically going to be implemented, and the impact on potential profit down the line. So I think that's a good segue for me to go to Rob to talk about the more detailed aspects of windfall gains tax, and also the bill that was released over a week ago. So I'll hand over to you, Rob.
All right, thanks, James. So you've got all the good news from Chow. I'll give you all the bad news now about all the taxes. So as James said at the outset, we had a session, I think about May, which followed the budget announcements of this windfall property gains tax. So we now have a bill which was released about 2 weeks ago. I understand that it's due for debate tomorrow in the House, so it's passing through rapidly. Now, the good news is that the start date, which was originally announced to come into effect on 1st of July next year, 2022, it's been deferred until 2023. So we've got a further year before it actually becomes effective. And it applies to uplifts in value resulting from planning rezonings that take effect on or after 1st of July 2023. So anything that occurs before that date, if the planning approvals go through, it won't be impacted. But anything after 1st of July 2023 is potentially going to be subject to the windfall gains tax. So I'll run through how the windfall gains tax works, how it's calculated, and there are also some transitional rules that we'll run through towards the end as to projects underway that might be subject to the transitional protection. So the windfall gains tax applies where the windfall gain, the uplift in value, is more than $100,000. If it's more than $500,000, you'll see the rates there. The windfall gains tax is effectively 50% of the uplift. Now, those rates were announced in the budget, so they're not new. The marginal rate there between 100 and 500 just means you get the first 100,000 free. So the 62.5 is incremental. So for 49999, you effectively hit the 50% rate. It applies to all properties that are impacted by a rezoning. So if you've got a number of properties impacted, then it's the aggregate of all the properties. And there are also some grouping rules that we'll get to. As I said, if it's less than $100,000 uplift, then there's no windfall gains tax. Otherwise, you'll be subject to the tax. Now, windfall gains tax won't apply to sales and options that were entered into before 15th of May 2021, which is budget night, where the sale is completed after the rezoning. Obviously, if it occurs before 1st of July 2023, it's not going to be impacted. But if you've got long dated contracts, which might settle sometime after 1st of July 2023, where the sale is completed after the rezoning, so contracts that are conditional upon the rezoning, then they won't be impacted. Now, that's just a reflection of the value that the prices will have been struck without taking windfall gains taxes into account. They only apply to contracts and options where the price is actually effectively locked in. They won't apply to open positions like rights of first refusal or similar arrangements where the price hasn't been locked in. The uplift in value, how's that calculated? That's just a simple comparison of two values. One is the existing capital improved value, and the comparator is hypothetical capital improved value, which will be struck by the valuer general by way of a new valuation, supplementary valuation, which is determined on the same date, but on the basis that the property had been rezoned at that date. So for instance, if it occurred today, the effective date of your capital improved value is the 1st of January 2020. So the 1st of January 2020 applies to the 2021 land tax year and rating years. So you go back to the 1st of January in the preceding year. The CIV2 is a hypothetical value as at the same date, based on all the same assumptions, but with the assumption that it had been revalued at that date. That's a purely hypothetical valuation. How the valuer general is going to determine it is going to be subject to some degree of interest. The valuation is based on a single title. So where you've got a single title, but multiple occupancies, you might have a number of different capital improved values. They'll be aggregated to work out what the value is for the single title. Equally, where you've got a single occupancy in more than one title, and they just apportion it. As I said, there's grouping provisions, so related corporations or companies under common control are grouped effectively. So if you've got a number of properties in the same corporate group that are subject to the same planning scheme, they'll be aggregated to work out whether you go over the $100,000 or the $500,000 uplift. Equally, there are some complex provisions about grouping land held on trusts. So trusts that have got common controlling interests, including discretionary trusts, might be grouped. Sorry, I should have said at the outset, we're happy to take questions. We will have time for questions towards the end. So if anybody has any questions, put them in the Q&A box and we'll address them. We'll have time to go through them towards the end. Now, importantly, windfall gains taxes can be deferred. They can be deferred for up to 30 years. Interest accrues on the amount deferred. So it's calculated on the 10-year bond rate, applying from time to time. The windfall gains tax will constitute a charge on the land and will be included on property clearance certificates, so just like land tax clearance certificates. When the property is sold, the windfall gains tax will become payable at that point. It may also become payable when certain other dutiable transactions take place under the Duties Act. So that includes transactions which trigger landholder duty, so change of 50% or more of a company, or change of 20% or more of a trust. Now, if you trigger the landholder provision, so by acquiring a 20% interest in the trust, it's not just the 20% that becomes subject to windfall gains tax, it's the whole whole amount becomes payable at that point. So you'll need to be careful about dealings in landholders where windfall gains taxes might apply. Subdivided land. The windfall gains tax, as I said, is a charge on land, and that will carry through to subdivided land, so from parent to child titles. Importantly, it only carries through to the subdivided lots. So if you've got land that either becomes public land or becomes roadways or becomes parks or otherwise, that's not going to be included. It's going to carry through to just the lots included by the subdivision. So they're going to carry the full burden of the windfall gains tax on the parent title. Residential land, it doesn't apply to residential land of up to 2 hectares, where the residential land is on a single title. It doesn't have to be principal place of residence, it's just any residential land of up to 2 hectares. It will apply to some farmland to the extent that there's a residential property on that farmland and it all belongs to the single title. There are exemptions for charities. Charities don't pay windfall gains tax on land that they continue to occupy and use, so long as they continue to use it for a continuous period of 15 years. There's also an exemption for errors to correct Victorian planning provisions or planning schemes, which is probably understandable. One point I might make, as I said, it applies to rezonings. It applies to rezonings from one zone to another, so industrial to residential, primary production to residential or industrial. It doesn't apply to changes within a zoning. So if you go from industrial A to industrial B or something like that, it won't apply there, but it will apply to any changes between types of use, so industrial to commercial, for instance, or industrial to office. There is as I said, a transitional provision for rezonings already underway. So again, the critical date is 15th of May 2021, which is the budget day. If the rezoning had already commenced, so if it had been included in the amendment tracking system by the relevant council, then it's effectively quarantined, so it won't apply. However, it's important to note that's not when you started the process, that's when it became registered in the amendment tracking system. So there might have been planning applications that were underway before 15th of May that weren't in the amendment tracking system on that date. Also, anything where there's been a request to the planning minister directly. So anything that's with the minister on the 15th of May is effectively quarantined. You have to have spent a threshold amount being 1% of the CIV immediately before the rezoning event, or $100,000, whichever is the lesser. So, yep. So that's fairly important for anything that people have underway. Now, just briefly, I'll touch on build-to-rent concessions, which are also included in the same bill. I think we've got a bit of time. So build-to-rent concessions were also announced in the budget. That is a 50%, results in a 50% reduction in land tax for up to 30 years. And also means that the purchase of the land is not subject to absentee owner surcharge if it otherwise would be. That follows on from a similar scheme in New South Wales, which was introduced last year. The Victorian provisions on one level are probably less onerous, just requires that there be 50 self-contained dwellings. They have to be owned by the same owner. Now that can be in joint ownership, or it could be in a company or trust, but all the 50 dwellings have to have the common ownership. So it has to have to be the same joint owners or the same company or trust. There has to be a single management entity. Has to become suitable for occupancy. So that's an issue of the certificate of occupancy after 1st of January 2021 and before 2032. And the apartments have to be available for rent under residential tenancy agreements. The tenant must have an option of at least 3 years, although they can elect to have a shorter term. So that's a fairly large concession for build-to-rent schemes, but you do need to maintain them as build-to-rent schemes for at least 15 years. If you don't, then effectively all the benefit is clawed back, and you'll be charged all the benefit plus interest going back to when it would have otherwise been payable. Note that there's no automatic exemption from the absentee owner surcharge on the purchase of the land. There are exemptions under the existing Treasurer's guidelines, but they're slightly different parameters, so you've got to apply for those. And I think that's pretty much it. So I'll hand back to James see if we've got any questions.
Thank you, Rob. Thanks, Rob, for your insights. And just before we come to the questions, we've got a live poll question that's going to appear on the screen. So once you answer the question, it will disappear. And we'll share the results of the question with you, as well as the slides that we've shared today and a copy of the recording via email later. So I guess, Rob, I've got a question for you in terms of, I guess, some of the detail regarding the windfall gains tax. I've noticed that in your presentation, and we've gone through the bill as well, in terms of the value that's used, because that's quite critical, right? When we work out what the amount to tax on, can you give us some more sort of example or some more experience around how that value is determined? Because, for example, when you buy a piece of land and then you do a land banking, that purchase price is obviously not the value that's being used. So how do they then determine what is the value that is the base, and also what is the value that is the uplift?
Yeah, that's a good question, James, and perhaps I should have gone into a bit more detail with it. So as you've indicated, the windfall gains tax is based on the hypothetical uplift in the capital improved value. So it's not actually a tax on your profit. And as I said, the CIV goes back effectively up to 12 to 18 months or so. So it goes back to the 1st of January in the preceding year. Now, if you've come along and purchased the property this year and paid market value for it, and it's gone up in value, that's not going to be reflected. You're going to go back to the existing CIV as at 1st of January 2020, and then the Valuer General is going to do a hypothetical revaluation of that as at 1st of January 2020 to work out the uplift. So that doesn't represent what you paid for, particularly if the market's moved in between the date of the valuation and when you purchase it.
Okay, well, that's really good. We've got a few questions coming through now. So Cecilia is asking, is the windfall gains tax applicable to Metro Vic area as well? Or clearly it's on regional land, but is it also applicable to the Metro Vic area?
It's applicable to any area except for what's currently in the growth area infrastructure charge. So area that's subject to the GAIC at the moment, GAIC, which is the designated growth areas, are not subject to the windfall gains tax, but it applies to anything else. Obviously, it's going to have less impact in regional areas because the uplift will typically be less, but it could apply to anywhere, Wodonga or Bendigo or anywhere.
So Rob, just for people that are probably not familiar, can you tell us a little bit more about the existing GAIC and how that interacts with the windfall gains tax?
Well, it doesn't interact. It's either one or the other. So the existing gate applies to growth area, designated growth area infrastructure zones around the outer urban area. So around the fringes of the Melbourne metro area. If it's a designated gate area, then it's subject to a gate charge, which is calculated on quite a different basis. It's just a flat dollar per hectare amount, and it varies from one area to another, but it's a flat charge. So it doesn't have any comparison. So whether you incur a gate charge or a windfall gains tax charge, you're not going to be able to compare them very easily.
Okay. I guess one thing to note is also with the payment of the windfall gains tax, and say you realize the profit from your property eventually, there will be we would expect that there will be some sort of recognition of that when calculating the income taxes, such as capital gains tax or profits tax. So it's not likely that you'll be double taxed, but obviously the detail around that we'd have to look into as well.
Yeah.
So another question from John Few. So if there is no change of zoning, but just the height or density, will this WGT still apply?
The answer to that, John, is no. As I said, it's only where you change from one zoning type to another. So if you're staying in the same zoning type and there's just a change to the height or density level, that's fine.
Okay, great. Another question. So if we're purchasing turnkey properties from a developer for social or affordable housing purpose, then I think this is a practical question. Will the adjustments be at settlement, such as, for example, the windfall gains tax, land tax, council rates, pose as a registered community housing provider?
I don't know the answer to that one. I might have to take that one on notice. There's no exemption as such from the windfall gains tax for social or affordable housing projects. And as I said, if you're contributing land for public purposes, effectively the windfall gains tax flows through to the remaining lots. There are some regulations to be made at some point in the future which will allow some deductions. So whether contributions to social or housing purposes or to other public purposes might be deductible somehow is something yet to be determined, and we probably won't see those regulations for some time.
Yeah, I think there is still quite a bit of unknown because this is a new sort of bill that's being introduced for a new concept. And I suspect, I mean, there's still a lot of consultation going on, and more detail will be made clearer as this thing comes into practice and practical issues come up. So, so some of these questions, yep, sorry, Rob.
I was just going to add to Xing Ling's question.
Yeah.
I'm not sure how the windfall gains tax would be adjusted at settlement. The Standard Law Institute contracts for sale, for instance, obviously don't provide for them at the moment, and I'm not sure how they'll actually draft them to adjust any windfall gains tax at settlement. It falls on the owner at the time of the rezoning.
Yeah.
So it'll be the vendor's liability, but whether they seek to adjust it is another thing.
Okay, so Kwan is asking a question around a potential change of zoning from industrial to commercial 1 in Collingwood, and whether WGT would apply in that circumstance.
Potentially, yes, because it's changing from industrial to commercial. If the uplift is $100,000 or more, then potentially yes, if the rezoning occurs after 1st of July 2023.
Yep. And what about the future expansion of the urban growth boundary?
Right. So, Kevin, if land is moved into the urban growth boundary, it ceases to be subject to the windfall gains tax and becomes subject to the gate charge. So land moving into the urban growth boundary won't trigger a windfall gains tax.
Okay, so this is a question on BTR. So we have the question that if you build a block of apartments for lease, so do you automatically get the land tax reduction?
No, you'll need to satisfy, there's a number of conditions. So first of all, will have to be 50 build to rent. And they come with a number of other conditions that would need to be satisfied before you get the land tax reduction. And it doesn't automatically apply. You've still got to apply to the Commissioner for it anyway. But it's not going to apply to just anything that's apartments built to rent. They have to be, as I said, 50 apartments that are available for rent. They have to be available for a minimum period, and they have to be available for residential tenancy agreements. There also has to be central management and control of the apartments.
Yeah.
So there's a number of conditions on that.
I guess they're also trying to ensure a certain level of scale as well.
Yeah.
Okay, I think we've answered all the questions that have been posed to us, but one which Shenling will get back to you once we find out some more details. Yeah, so if there are no more questions, we will, hold on, let me just have a look to see if we have any other questions. So if anyone's got any last minute questions, please ask. Otherwise, we have the opportunity to email any of us following today. We will be sending through a copy of these slides that we presented on, as well as the recording as well, if you want to go back and listen to some of the things that we've shared. Especially with the windfall gains tax, there is a lot of detail that is in the bill and the proposed legislation. So we are happy to answer any further questions, particularly when it comes to certain practical situations that don't fit into what we've gone through. We probably need to look into more detail as well. And also, I'd like to thank Chow and Rob for your insightful presentations. I'd also like to thank Amber and Barnaby from Align Law. They are our legal, they are there if you need any legal related support following this presentation. We'd also value your feedback on the session. So please complete our feedback survey, which will pop up on your screen at the conclusion of this webinar. We look forward to providing you further updates in due course and hopefully in person for our next session in the series. And we would love to meet all of you in person, and I'm sure we'll get a very lively sort of questioning answer type session similar to our first one the next time if we're able to hold it in person. So thank you for joining us, and I hope that you stay well and stay safe, healthy, and we hope to see you all soon. Thank you very much.
Bye.
Bye.